Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Prerana Seth, Fixed Income Strategist. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. In today's episode, we are happy to discuss our outlook on the GCC fixed income markets. GCC sovereign credit recorded positive gains in 2023 and has performed well so far year to date, riding along with the emerging market bond rally which started in the last quarter of 2023. But overall, GCC sovereign has been underperforming emerging market bonds, with only the high yield names including Oman and to some extent Bahrain managing to outperform emerging market peers. Better quality GCC sovereigns have seen only modest gains compared to emerging market peers on account of investor search for high yield. Despite the recent underperformance, we remain positive on the GCC fixed income outlook and maintain our preference for the region. Macroeconomic conditions for GCC credit are likely to remain supportive in 2024. Starting with the external factors, the Fed is likely to start its easing cycle in the second half of the year, which will be a tailwind for the global bond markets in general. Emerging market bonds should benefit especially if the Fed easing cycle is accompanied with soft global growth slowdown. GCC economies will also stand to benefit, in fact the most, given their peg currencies will follow the Fed rate cuts, and GCC sovereign credit will track that decline in developed market sovereign bond yields. In terms of domestic factors as well, GCC sovereign credit stands out with its strong growth prospects, growth diversification efforts, better fiscal and external positioning score against emerging market peers, and benign inflation. Fiscal balances still remain healthy despite some deterioration seen in 2023 due to lower oil prices and higher spending. We expect the GCC sovereign US dollar credit supply to be higher in 2024 with range-bound oil prices and higher government spending. This has already been evident in the bulk of issuances seen since the start of the year, with cumulative issuance year to date matching almost 68% of the total issuance in 2023, that is in case of the sovereign credit, and in case of corporates, year to date issuance this year has already surpassed the 2023 total. We have witnessed some big bang issuances in the GCC, including Saudi's 3-tranche $12 billion sale, which already accounts for half of the projected deficit requirement in Saudi Arabia. However, higher bond supply is not a concern, given that it has been backed by strong demand so far, with average bid to cover ratio of over 4 times this year. Secondly, an increase in potential spending is also likely to be partially funded and backed by state-owned enterprises. In terms of valuation, GCC credit spreads are trading tighter than the broader emerging market universe, but that comes with an overall higher credit rating in the region compared to emerging market peers. Any jump in volatility in the oil prices is likely to put upward pressure on the credit spreads, but overall we believe that the impact of oil prices on GCC credit spreads has reduced given the diversification into non-oil activity. Given our overall preference for high quality fixed income this year, we prefer GCC sovereign bond markets. GCC paper has shown resilience and will be more favored compared to other emerging market peers given the quality and better rating of the sovereigns in case of rise in volatility and global risk-off sentiment. As always, thank you so much for listening to our podcast. We hope you find it useful. If you do, please share it with your family, friends and colleagues. For more information, please reach out to your contact at ADCB. You can also log into our website www.adcbam.com. This is Prerana Seth signing off.